Hello, in today's video, I want to go through, should you invest in real estate like rental properties, or should you invest in real estate investment trusts, which are essentially real estate stocks in the stock market? I want to give you, obviously, before we dive in and explore either of those, I'm going to give you an overview of what type of real estate I'm talking about when it comes to rental properties, as well as what is a real estate investment trust. Then I'll go over, okay, the number crunching, which one reigns supreme? And then, of course, I wanted to also go over what type of investor would it be suitable for? Because if you're looking to invest in real estate or dabbling into REITs, real estate investment trusts, then this video is for you. And most importantly, I want to reveal a couple of strategies you could follow if you're in your 20s, in your 30s, or your 40s or 50s if you want to go and invest in real estate. What is a REIT versus residential real estate? So we're going to talk about the REITs of the world, which are the real estate stocks in the stock market. And REITs generate a steady rate of income for investors, typically in dividends as a form of its return back to the investor, but it offers very little capital appreciation. We'll dive into what I mean a little bit later. When I'm talking about residential real estate, I'm talking about standard starter homes that you can buy and rent it out. So essentially, you become the landlord and you rent it out to tenants, and the tenants pay down your mortgage. So which one makes more money? Let's dive into that right now. When we're talking about REITs on the stock exchange, in the stock market in Toronto Stock Exchange, we see RioCan, which is an investment company that owns shopping centers, retail, a little bit of residential development, and we've got smart centers, which you could check out that video right here. But what I'm trying to say is that these stocks essentially own assets. And you could look at the stock market for these types of companies, even if in the ETF, you could see that over time they've returned decent returns to the investor, but they don't actually track the real estate market. So if the real estate market, say a property starts increasing with inflation, that doesn't necessarily mean that the stocks increase accordingly. The way the real estate investment trusts work is that they collect rent from their tenants, and then they distribute a huge portion of that back to the investor. So the more rent that they collect and where they can cut down expenses, they can return a bit more to the investor over time. So it really comes down to how well do they manage their company. And the way that real estate investment companies grow is that they have to continuously acquire more and more properties so that they could grow their portfolio, so their company's worth more and their stocks are worth more in order to gain appreciation. Now, what does that mean in terms of your shares? So over time, if the company has to keep continuing to grow and needs to raise more capital, it could issue more shares in the stock market, which then dilutes the company because there's more shares to be shared around. So that's why if you look at the real estate investment trusts, they don't just skyrocket like a growth stock. No, over time they return a steadier return to you, but they don't necessarily track the real estate market. Now, so let's flip over to residential real estate, which is something that I love, and I started really young, and it has been the biggest boost in my net worth and in terms of gaining income. So let's look at the Canadian real estate market. As you can see, even in Ottawa, the city that I'm living in right now, housing prices have steadily beat inflation year over year. And when you put a tenant in and buy a property, they have many ways where you can make money off of rental properties. The first one is the obvious, which most people know, which is capital appreciation, meaning the housing prices go up over time. The second thing is that the tenant is paying down the mortgage on that rental property. So that's a second way of making money. The third way is there's a ton of tax deductions you can get with rental properties, which you don't necessarily get with the stock market with REITs, because the REITs, the investment companies, gets that tax deductions back to the company, but they don't necessarily give that back to the shareholders. So let's look at rental properties. When I'm talking about rental properties, I'm talking about focusing on residential rental properties being like starter homes, being a townhome or a condo or a duplex or a triplex, where you essentially buy the property and then you rent it out to a tenant, and the tenant returns rent to you, which is income returning back to you. Now, in terms of the ways it makes money is first, which most people know, is housing prices. Housing prices have gone up over time when it comes to residential real estate, as you can see in Canada, as you can see in Ottawa, as you can see in Vancouver and Toronto. That's just on average because it usually beats inflation. And as interest rates drop, housing prices tend to go up. The second way is that the tenant obviously pays down the mortgage, which gives you another form of income back to you. The third way is that you get a lot of tax deductions with owning residential real estate. The government looks favorably at saying, hey, you are essentially owning a bit of a business, so you can write off mortgage interest, you can write off your property taxes, you can write off expenses. There's so much that you could write off that essentially the income, the cash flow that you're gaining, say from the rent minus all the expenses, could be tax-free to you. Tracy, I'm still confused. I don't know what I should do. Should I go into REITs or should I go into residential real estate? Thanks for letting me know that residential real estate makes more money, but how do I know if it's going to be suitable for my, personality and all that? So that's what I really want to get to right now because it really comes down to your investing style. Are you the type of person who's like, no, I'm a passive investor. I don't really even understand how to choose a rental property. It sounds like a lot of work. I don't want to deal with tenants. I don't even have the capital to go buy a residential rental property. So I'm going to go buy REIT. So that's really the answer, is that essentially you're okay with lesser returns. You're okay with having an investment company basically run the whole thing, and you don't want to be involved. And also you want to be able to just sell your stocks, your REITs right away because you want the money back fast. So that's the type of investor it is suitable for. Now, if you are an active investor like I am, who likes to like actually has quite an entrepreneur spirit and has the will and the determination to go find the right property because you want to be actively involved. You like seeing brick and mortar assets because it's more real to you, and you like knowing that you're in more control of the property because, for example, if you did a little bit of landscaping on the property and you did a little bit of paint, you can instantly boost the property value just by doing those two things. But you can't do that with a REIT because, like you're a passive investor, you've outsourced it all to the investment company. But if you are more like, I like to get my hands dirty, then residential real estate probably is a good path for you. But the thing about being an active investor in residential real estate is that you do need to treat it like a business because it really is a business. You have to file taxes, you have to market the property and find tenants, you have to actually you have to invest a big chunk of money into the property so that you could go buy the property. But the great news is that you can use leverage and get the banks basically lend you most of the money to go buy a big asset. So what kind of property can you get where you buy $300,000 property and put as little as $15,000 in and own a business that's worth $300,000? That's really what I love about real estate, is the fact that you can use leverage to magnify your returns. Now, the downside of obviously buying residential real estate property and being an active investor, it does require more involvement. Even as a busy professional like I am, I still spend a couple hours every single month watching over the portfolio. Now, in the grand scheme of 2 hours a month, it's really nothing, but sometimes it does require a little bit of headache. And say, for example, even if you have a property manager that's running and managing your property, they're going to ask you questions like, oh, there's a tree that's not doing so well, you got to get it cut down. It costs $2,000. So residential real estate requires coin, it requires money. But if you do it right, you can magnify your returns. Now with a REIT, if something goes down, you just see paper losses. But then it can also do really well and you can see the returns, but again, it's paper gains. With residential real estate, the gains and the losses are much, much slower. You can't see it day to day, and that's actually also something I really like. But the bad news is that you can't just go ahead and get your money back and sell the property. The residential real estate is quite illiquid. You can't just say, hey, I want to sell my property like tomorrow and get the money back. No, it takes months to get your money back. But if you do it right, the returns can be magnificent. So I wouldn't go into residential real estate if you need your money back right away. Now, let's talk about, say you are interested in both and you're trying to decide, well, what should I do? How do I do both? And that's what I want to talk about next. Is like, if you're in your 20s and 30s, 40s and 50s, I want to share a couple strategies that you can do if in that age range. So let's talk about if you're in your 20s and your 30s. Now, obviously, during this time, you just probably started your profession. You're not going to have a ton of coin. So I would say go ahead and start as little as $15 using the Wealthsimple Trading app, which I have a link down here where you can buy RioCan, Smart Centers, or the ETFs that covers real estate investment companies and tracks them. And you could buy those stocks, and then all of a sudden you are a real estate investor. And then as those companies grow more and more money, they return a bit of dividend back to you, the stock is worth more money, then you can sell those stocks and then dump it into your registered retirement savings plan. If you're in Canada, because in your RRSPs, you can, in Canada, they allow you to withdraw that money and buy your first home. And then when you buy your first home, treat it like your rental property where you decide, hey, you live in it for a year, you do a little bit of work, and then you move out and then rent it to a tenant. That would be the amazing strategy if you're in 20s and 30s, if you want to do both, because that's actually what I've done. When I was in my 20s, I bought stocks and then I gained some money and started saving into my RSPs and went and used that to buy my first condo, which then became my first rental property because I moved out of it and rented it out. Now, if you're in your 30s, if you're in your 40s and your 50s, you're like, Tracy, no way am I going to do that because I'm not going to move out of my home. I have a lot of stuff. I have kids. I've got, it's close to work. That's a lot of work. And that's why I'm going to reveal a strategy for you. If you're in your 40s and your 50s and you want to go invest in real estate, you probably own a home right now. And it's probably worth a pretty penny, especially if you've been actively paying down the mortgage and you've had it for quite a bit of time. Then what you do is you go to the bank and get a secured line of credit against your home, which is essentially is a loan against your home because it's worth a ton of money. Then you could take that home equity line of credit and use it essentially like cash to go buy a residential real estate property, like a rental property. But you do have to put 20% down, so it requires a bit of coin, which is why I said instead of using all your savings, you can actually use the HELOC to go buy that rental property. And then what you do is you be very selective with buying a rental property. And if you want to know how to buy rental properties the right way, I have a course, which is the 7-Figure Investor School by myself that I've had a lot of students take. But all I'm trying to get at is please choose the right rental property. And then if you choose it right, then you will make great returns for you. And you can go and get tenants, get the mortgage paid down, and rinse and repeat, do that year over year where you can get HELOCs against those properties and go buy more properties. So anyways, I hope that you found these strategies helpful because what I'm trying to show you is that you can do actually both. And but for some of you, you're probably going to say, I don't want to do residential real estate. I am not an active investor. Hey, that's okay. Then go buy REITs. Or you're going to say, ooh, REITs, those like that return is not that great. And I like to be, get my hands a little bit dirty. I'm an entrepreneur. I like owning a bit, like having a type of investment that's kind of like a business for me. And I like seeing it, I like visiting it, I like being able to control it. Well, then you got to go check out buying residential real estate and check out my course, which is the 7-Figure Investor School. Anyway, I hope you found this video super helpful. If so, give me a thumbs up and let me know in the comments below which one do you choose. Would you go more for REITs or would you like to own residential rental properties in the future? Or you just want to do both? Let me know. I always respond. Okay, talk to you later.